Welcome back. Earlier today, the S&P Shiller Home Price Index was released. Home prices in May rose for fourth straight month. The 10-city composite year over year fell 1%. The 20-city composite fell 1.7% year over year. Now, the black line represents a home price index. This is the net number, not the year over year figure. We can see the green histogram bar shows us the number of days we have to go back to see a higher high. The red histogram bar shows us a lower low. And we can see that this index has not seen higher highs or lower lows, especially higher highs, in over almost 300 days. We're right near the top, although lately we have marked again year over year slight declines. This is a 20 city home price index. It's the same type of pattern. We're close to very significant highs, but then again, we're also close to very significant lows. We've been in a trending pattern for the past couple months, but the next big move could be indicative of what's to come. Here's the all transactions house price list. This is right near the top. We're literally on 600-day highs that we have not seen in quite a long time. This again is an all transactions number, which is also very widely watched. Over here, we see the home price index in comparison to the federal funds rate. By the way, the Federal Reserve is set to meet tomorrow. They're expected to raise interest rates another 0.25%. Now, we go back to May of 2022. The home price index was quite strong until the Federal Reserve started to raise rates. However, as the Federal Reserve has continued to raise rates from May of last year through present day, the home price index has recovered. We're experiencing what's called the lock-in effect, where these high interest rates are not only locking out potential buyers, but locking in potential sellers. Seller doesn't want to sell if they're going to have to take on a new high interest rate mortgage. It's something we're going to talk about in the weeks to come because it's a phenomenon that's not very common, but it is happening now. Now we see here the red line is the S&P 500, the black line is the home price index, and a pretty strong correlation. When stocks go up, so does a home price index, and we're right near record highs. Today actually marked the first down day in the past 12. Yesterday we spoke about the 11-day winning streak on the Dow Jones Industrial Average. Now, here the black line represents a home price index. The green line is a 1-year U.S. Treasury. The red line is a 10-year U.S. Treasury. We still have a very, very significant inverted bond curve where we have the 1 year. Again, the green line is far above the red line. And it shows us that in the short term, the bond market is expecting higher interest rates, but over the long term, the bond market is not predicting very strong economic conditions. Now, this is the Case-Shiller U.S. National Home Price Index year over year now. That's the red line. The green line is a 20-city composite. They're very close. This is what we look like now, going back to November of 2020 through present day. It actually was very strong. Now, this is the difference. If you look at the net number, it looks like it's increasing. But the year over year comparison has actually been in a very, very steady decline, hitting tops June of 22 last year, and then now coming to the downside. It's important to note that the year over year measure, I believe, is more significant because there are seasonal factors, especially that go into the housing market. So we compare this May to last May, this June to last June, and we can see on a year over year basis, there's been a very steady decline. Now, again, this shows us present date what the pattern looks like. This chart shows us starting in 2002 through 2009, the steady decline as well. We were reaching highs of 10, almost 15% year over year strength in 2004. We all know what happened to the housing market in 2008, but notice how The year over year declines began around 2005. The home price index really started to decline far before, 2 to 3 years before we actually saw that housing market crisis. So this really puts into perspective the current decline that we see now. It could, there also could be a 2, 3 year delay as there was in 2005, leading to that 2008 housing market catastrophe. But it's very interesting to see how the housing market really started to crumble on a year over year basis far before we actually saw the crisis at our footsteps. Again, we have Federal Reserve meeting coming up along with durable goods, GDP, and inflation numbers also this week. So we'll be sure to revisit the economic calendar and any significant developments along the way. We hope this has been helpful. We look forward to seeing you back soon.